Hello, and thank you for joining Armbruster Capital Management's Investing 101 series. Today, we're going to discuss Required Minimum Distributions, or RMDs. Understanding these points can help you manage your retirement accounts efficiently and avoid potential penalties for not adhering to IRS rules. What is an RMD? An RMD is the minimum amount of money that you must withdraw annually from your tax-deferred retirement accounts, like IRAs, 401ks, or 403bs after you turn 73 years old. RMDs are required by federal tax law, and penalties for not taking them on time are significant. Your first RMD must be taken by April 1st after you turn 73. How much do you need to take? RMDs are calculated annually based on your account balance as of December 31st of the previous year. You can look at your year-end statement for that value. The amount due is calculated by dividing your account balance by a life expectancy factor based on your age as of 12/31 from the life expectancy tables listed in IRS Publication 590B. Here's a table from the IRS that shows the age and distribution period for unmarried owners, married owners whose spouses aren't more than 10 years younger, and married owners whose spouses aren't the sole beneficiaries of their IRAs. Please note that there is a separate table for people whose spouses are more than 10 years younger. If you inherit an IRA, there are separate rules and tables as well. Those can be found on the IRS website at www.irs.gov. Why are there RMDs? RMDs were created to prevent taxpayers from indefinitely deferring taxes on their retirement savings. It allows the government to collect taxes on those funds, because RMDs are considered taxable income in the year you take them. It also encourages retirees to start using their retirement savings. What happens if you don't take your RMD? If you don't take your RMDs as required, the penalty is 25% of the RMD amount. But if you make and subsequently correct an error within 2 years, the IRS may reduce the penalty to 10% for individual retirement accounts. What happens if you have multiple qualified accounts like IRAs, 401ks, or 403bs? If you have multiple retirement accounts that qualify for RMDs, you need to calculate the distribution for each account separately. Here's where things can get a bit confusing. If you have more than one IRA or 403b, you're allowed to take the total from just one account. But if you have multiple 401k or 457b accounts, you need to draw from each account separately. To simplify this a bit, here are the types of retirement accounts you need to take RMDs from. For individual retirement accounts, or IRAs, they include traditional accounts, rollover accounts, if any pre-tax assets are included in this account, inherited accounts if determined by your beneficiary status and at what age the original account owner died, simplified employee pensions, or SEP accounts, and savings incentive match plans for employees, or simple accounts. For qualified retirement plans, they include KEO plans, individual 401k plans, and 403b plans. You can withdraw more than the RMD from your accounts without penalties, but it's important to know that the withdrawals will be taxable as ordinary income and don't count towards future years. If you don't need the money from your RMD and don't want the tax liability that comes with it, you can do a Qualified Charitable Distribution, or QCD. This allows you to donate up to $108,000 for the 2025 tax year to charitable causes that are meaningful to you without it counting toward your taxable income. We will explore QCDs in another episode in our Investing 101 series. You can also contact your financial or investment advisor to find out more. Who are we? Armbruster Capital Management is a fee-only investment firm that provides financial plans and investment management services for individuals and families, nonprofit organizations and foundations, and establishes and manages retirement plans for employers. Check our website at www.armbrustercapital.com for more information and subscribe to our channel for more videos in this series and additional content. Thanks for watching.